To our first episode of 2024 of the Selfwealth Live, calling it Traders Edition. I'm excited for this year, Jason. Welcome once again. Happy New Year. I hope you had a great break. How's everything going on your end?
Yeah, g'day, Rog. Good to be back. Good to be back talking about a few charts about the markets. Plenty of interesting things going on when we look around the ASX, the US markets, all those individual stocks. And what I'm excited about doing this year is like applying a lot of the stuff that we spoke about last year in those in the series of technical analysis generally, where we looked at trend lines and moving averages, and now this year we can bring it all together and help looking for those individual opportunities, how to apply process, how to use good trading rules when you're approaching the market. So yeah, it should be a bit of fun.
Yep, and that's what today's episode is going to be about. We're going to be looking at the markets overall. We're going to be looking at a few winners and losers, and then we'll go to we've got a few tickers from the crowd, I should say, ready to have a look at that from a technical perspective as well. I want to welcome our guests, obviously, our clients that are watching this, our people that are on YouTube watching this. Thank you for attending. We hope you enjoy this round of this series as well. We're hoping to continue each week on a Tuesday at 12 o'clock at this point. So don't forget to put that in your calendar. Like and subscribe on our videos, as well as give us a comment if you like, and we'll be sure to monitor those as well. I'm Roger from Selfwealth. Our disclaimer's in the comments. Jason, I'm going to pass you on to you because you've got to talk about your stuff.
Yeah, everything we do today is general commentary only, no personal advice given. And I just quickly throw up a disclaimer for you to have a look at, and that just tells you all those important things. General advice only. And I'm not part of Selfwealth. I'm part of Motion Trader. Motion Trader is my business, and you can see the details there, my licensing details and so on. The disclaimer along with Selfwealth. And if you need personal stuff, personal advice, well, you get that separately. This is all the general commentary, general ideas, give you some thoughts, and then you do what you will.
Yeah, exactly. We're really here to educate people on the technical. Well, in this series, in this episode, we're talking more around technical analysis, and we were just talking pre going on air about fundamental analysis, right? We've got a lot of great information on our website, articles. There's a lot of past historical videos on YouTube that talk all about the fundamentals and how to analyze stocks and all sorts of things. So feel free to just go in and check that library out. But I think this year we're going to talk a little bit more, once again in these series around technical analysis, but also might actually mix in a few things around fundamentals going forward as well. And that's going forward in the future now. But hopefully we'll have a good mix on this show as well. But for now, Jason, I want to ask, we had the traditional Christmas rally, and it seems to be continuing in our side, in Australia and America, but not in, let's say, China and Hong Kong. Can we start with having a look what the Australian market looks like at the moment? Can we have a look at that?
Yeah. Well, I think that's a pretty good place to start. So let's get some charts up on the screen. And so what we have here, we've got the that would be the ASX 200. Now, what I want to do, I'll actually switch off the ASX 200 for a moment because I want to go out to a weekly chart. And to get a weekly chart working well, I need to use the All Ordinaries because it's got a whole lot more data on it than the ASX 200. So there's the All Ords. Looks pretty similar, really. Now I'm going to go to a weekly because weekly is good. Just gives us that overall perspective, and then we can sort of like close in on what's happening most recently. And the thing I want to discuss to kick us off, it's this like the last 2 years really. Look at this. We've been in this big range bound period, which has been pretty difficult. It's been pretty tough going, I think, for most people involved in the markets. But what I want to do, just compress this a little bit. Now, I'm going to put a box around the last couple of years, and I'm going to do this over several periods, just to give some perspective as to like how these how markets markets work, in that markets just don't move in one direction. Like this nice smooth trend we had during the 2000s is not really the norm. The norm really is markets rally, then they fall, and then they consolidate. And these consolidations can go on for quite a while. And you can see how I'm just drawing these in. There's these boxes everywhere. These are these periods which last over a year, and then we go back into the late 80s, early 90s, and there's a big chunky one there. And to the end of the data, we can get one there in the early 80s as well. So when you look at it from this perspective, what we've seen over the last couple of years, it's not really out of character with what we've seen many times over the past. So yeah, we're going through one of those consolidations. They're not a lot of fun, but they are part of how these markets work. So let's now like close in a little bit more on the more recent time. So let's just go back to the ASX 200. Let's go to a daily chart. And so what we have here, so we go back to those COVID lows back in March 2020, big rally over 18 months, market put on something like 75% in 18 months, really strong rally. And the thing to always remember is when you get a big rally, it could be in a stock, could be in an indice, but big rallies lead to big consolidations. That's what we've been having over this last 2-year period. And remember that, getting that perspective from looking at the weekly chart. And I think what makes these consolidations so difficult is that they're really big sideways ranges, that they can be volatile. Sometimes they're not sideways. Sometimes you get these longer lasting bear markets where you get those 30, 40, 50% declines. Thankfully, they're only occasionally. But the other difficult thing with these big sideways consolidations is that they're discouraging, and they're discouraging because you get fewer trends and you get more false signals, more false breakouts. So you get stocks that start to go upwards and they reverse course, and you get all this chop. So that makes it discouraging, makes it difficult. And a lot of people go, look, these markets, they're not for me. They're just too hard. I can't make any money. But remember, this is part of the cycle, and this part of the cycle goes at some point, and then we'll move into a new phase. When you look at those charts, those periods we just saw, you typically move into those up phases. They return at some point. So yeah, just keeping the perspective of what's actually going on at the moment. So I think it's worth stepping back and looking at that bigger picture rather than just getting lost in this, in what we've seen over the last couple of years, which has been, as I say, it has been difficult. So where are we now? What's the current assessment? Well, much of last year. So last year is last year. Where's last year? Last year is this period through here. We spent much of the time just going sideways in a range. It was a pretty, it was a range within that bigger range. And towards the end of last year, we got this break to the downside. You can see this support. So support, something we spoke about in our series last year. So we had a pretty good support line through there. Market broke to the downside. We didn't get follow through selling. Now this is one of those occurrences I like to look for, where you get a false break. It's often a sign when you get no follow through selling that all those who wanted to sell had pretty much already sold, and it flips things to the upside. And that's what we saw from October. We got this really nice rally in the ASX 200, and something like, I think it was like 17% in a couple of months. So a pretty strong rally as far as rallies go. Now, so that brings us to where we are now. Now, I want to put on some moving averages. Let's get the moving averages on, because they help with assessing the current situation. Now I've got the 50 and the 100 day. That's what I typically use when I'm looking at assessing an individual stock or an indice generally. And so we've had this big rally, and the rally took us through to this major overhead resistance. I'll just compress that a little bit. You can see this is where the all-time highs are. This is the all-time highs of the ASX 200. We had 3 attempts at it between 2021 and 2022. The market fell away. we're back here now, had a big run into it. And so this is a very normal point for the market to pause and consolidate, catch its breath. It's come back to the 50-day moving average. Again, that's a pretty typical point to come back to. And we can also put some Fibonacci's on. I'm going to use this low point from November, because I think from November through to the high was a clean move on its own. The move from the October low, it rallied, then it consolidated, and then we got another rally through. So I'm measuring the Fibonacci's from that point. And so you can see we've got this cluster of supports coming in where we are now. So the Fibonacci's are sort of a target that you can use to give an idea of what a proportional pullback might look like. And then we've got the 50-day moving average and the 100-day. So often we get these pullbacks that come back within this range, and then find support and build a new base, a new platform from which they can then potentially then launch higher after some time pausing. And so that's where we are now. So this is where I'd expect buy the dip to come in if this is indeed the start of a move which can take the ASX 200 outside of this range to the top side that has been stuck in for the last couple of years. I think the play here is I want to be on the side of this upward momentum. So I think the play here is to be long. And I think it's as always, is to have stop losses in place, trailing stops in place in case the market does stall and start to fall back within this range, which is always entirely possible. We don't know whether the market's going to break out. We don't know what it's going to do. So it's about managing risk. So it's about, I think, being on the side of this momentum, see where it goes, see if we get some consolidation and then another extension of the rally, but using those stop losses in case the market starts to fall back. And I'm being a bit selective I'm being extra selective on what I'm buying just at the moment, just while the market's below this big overhead resistance. Buying these early stages of the rally, the mid stages of the rally all made sense, but once you get towards right beneath overhead resistance, it becomes not such an asymmetric time to be adding to positions. That's why I think a little bit more selective at this point. For me, the ideal scenario would be something where the market, we get a bit of back and forth for a few weeks, maybe a month, or maybe two, and then we start to launch higher. So you get to build a platform around support that the market can then rally off. But who knows whether it plays out like that? It rarely plays out as you think it's going to play out. But that would be a type of scenario which I've seen quite a bit. Rally to resistance, pause beneath it, consolidate, and then try and rally again. So there's some of the things to I think to keep an eye on, to look out for.
Yeah, nice, Jose. Thanks. One of the things that sort of you always get to confirm a lot of lessons when you look at charts over time. And one of the things that I was reading all the time during that down momentum phase, if you put the chart back up, because I was sort of referring to that chart, down part near the end of the last year, is you read the articles and it was starting to become doom and gloom out there, right? People predicting that markets were about to crash and go to the lows pre-COVID and whatnot. But I just to stay level-headed is one thing, and just once again, a lesson that I was always taught is, when you look at a chart, you sort of read the chart as it is, not try and predict what's going to happen too much off the chart, but read it as it is. Even though you're giving sort of predictions here, you're still only ever looking at the latest, bit of information, and albeit looked historically, but after that downturn, all of a sudden it just shot up like there was no tomorrow. So it's just really being able to read the charts as they are and not predicting where they're going to go too much, right? So
look, I think good chart analysis, it's about identifying possibilities. It's not about making predictions. This isn't crystal ball gazing. I don't know what the market's going to do, so there's no point making a prediction of what it's going to do. No one knows what it's doing. The fundamental guys don't know. The technical guys don't know. It's good chart analysis is about identifying the possibilities and then managing the risk around where those possibilities could be. And it's about looking for asymmetric setups where we can say, okay, well, we can take 1 unit of risk and potentially make 3 or 4 units of profit if that plays out. So it becomes a numbers game then. And so it's not about saying, I think that this time next week the market will be here. We can go through and say, well, there's a possibility it could travel this pathway, but that's not a prediction. That's just understanding the various ways something could build out, and really we're also taking the market's temperature in a way.
Yeah.
We're saying, look, is the market hot? Is it cold? Is it cooling? Is it warming? At the moment, I think it's warming, and so this is why I think the play is being long the market. But also with a bit of caution around key overhead resistance, and not saying, okay, it's going to break to the top side, because it may not, could fall back within the range. So that's where we're always managing risk. We're not playing on what will happen, it's what could happen. What are the possibilities?
Yeah, and that's confirmed basically by saying effectively you're placing trades based on what you can see right now, not on where you think it's going to go in the future, right? It's placing trades based on what you can see right now. So whether there's enough reward to risk for that trade, right? Not if you think it's going to go to a certain price where you've got absolutely no intel at all, right? So that's the beauty of what I love about technical analysis, right?
Yeah,
we also have a lot of historical information which we can base our trades off, right? So
yeah, we're responding to what is happening, and we have ideas around what could happen, but we're responding to what is happening. It's not about trying to outsmart the market, because that's not going to happen. It's if anyone who thinks they're cleverer than the market at some point pays a pretty hefty price, in my experience. So it's about responding and managing risk, and that's how we play the game.
Yeah. And what about those booming US markets? We've got a few all-time highs in there on the NASDAQ and the S&P 500, Jace?
Yeah. Well, look, S&P 500, US market has really been the place to be over the last year. So this is the S&P 500 I've got on the screen now. All-time highs just in the last couple of days. And it's really interesting, like how many people thought this was possible a year ago? Like you were saying, in October, there was all the doom and gloom around the markets when it looked like things were breaking low. And this is the equivalent point in the S&P 500. It did look like the market had lost its footing and was going beneath going beneath support. And and this is where I started to manage risk. I actually shut down some S&P exposure, frustratingly right near the low. Like it looked like a consolidation the whole way through, but then it gets to a point where you've got to make a call. And for me, I made a call, exited some positions, got the false break, market started to come back up. So then I started to put risk back on. And this is the thing, you can always put risk back on, but if the market does go into a tailspin and does come away quickly, you can't always take it back off where you should have taken it off. So it's again, it always comes down to we're managing risk. Managing risk comes before trying to hit the ball out of the park, because if you get bowled at the stumps, you're not going to get another chance to have a swing. So don't lose your capital. There are times you've got to protect that risk. And look, like how many people, like looking back a year ago, how many people thought this was possible? I was reading reports saying that 100% of Wall Street analysts thought the market was going to be down in 2023, and that was the first time that had ever happened, according to the articles I was seeing. And 100% of economists were predicting a recession, and it just goes to show, I think it's a mistake to try and trade off the headlines, trade off the price action, not the headlines, because the headlines more often than not just take you astray. And I think at the moment, I think the trend is very much to the it's very much to the top side. From a near-term perspective, look, I don't really want to be chasing stocks up here. I think the time to abort was during the rally through November into December. Now we've just poked up to an all-time high. Maybe the market does keep trending. So I want to stay long stocks. But as I was saying with the ASX 200, I'm just being a bit careful about adding to a whole lot of new exposure where things currently are. I just put those moving averages back on, so the 50 and 100 day, and we're not too stretched above it, but we are getting a bit stretched above that 50 day. You can see where the market got a bit stretched above the 50 day in July. We got that pullback. So quite often when a market cycles from below the moving averages to above, you get a pullback towards the moving averages, maybe some consolidation, maybe another rally. That's pretty normal for how these things work out. And remembering it's been an 18% rally in 2.5 months. So I don't think you'd want to extrapolate that forward into the next 2.5 months. That rarely happens. Does sometimes happen. So this is why you stay long, you stay with the trend, but I don't think you go piling in expecting a repeat of the last 2.5 months. Just doesn't seem like that asymmetric entry level for me at the moment. And it's also important to remember consolidations are a part of every healthy advance. It's normal to get a market that rallies and then you expect the consolidation. It gives back a little bit of gain and often forms a base, and that creates a platform for the next run up. Like the ASX 200, I think it's staying long, using those trailing stops. I never want to cap my upside. That's why I'm not someone who takes profit, except in extreme situations. I almost always let profits run. Don't want to cap the upside, but I want to limit the downside. That's why I use an exit strategy. That's where I use stop losses, trailing stops for when the trend turns down, and ideally a wide stop to help see off pullback. So my strategy now would be, if we do get a pullback, and if is the key word there, if we get a pullback, if my stops are relatively wide, I can hopefully see off the pullback, stay on emerging and developing trends, and then let them continue to do what they do, hopefully in the months to come.
Yeah, very good, Jason. Now, obviously, at Selfwealth, we also offer the access to the Hong Kong market. This is the opposite story to the last, to the other two markets. Let's have a look at that one. What do you think of that?
Yeah, well, this is it's kind of the opposite story altogether, isn't it? It's let's put I get those moving averages back. It's becoming more and more correlated to China, the Hang Seng, over the last few years. And let's just compress it. We're looking at a weekly first, just to get some perspective on it. And the data goes back to 87. So lots of data on this. And there's been times where this has been an absolute boom market, but it hasn't been a boom market over the last 5 years. It's really been locked in this relentless downtrend. There have been a few periods where the market's tried to recover, but it's never really spent much time above these moving averages. So being a weekly chart, these are 50 and 100 week moving averages. So you can see it's spent much of the last 5 years below the 100-week moving average. So it's never a solid footing, I think, for investing when a market is below those key averages. Just coming back to the daily chart, and we can see that look, the Hang Seng's approaching this previous low point. Previous lows can provide some sort of support, but I wouldn't be looking at that as a potential turning point at this point. I just don't think there's anything to do here while the market's below these moving averages. Ultimately, the market will bottom below the moving averages. That's just how it works. The low point has to be below the moving averages after a big bearish period, but you just never know where that's going to be. So I'm not going to try and preempt it. I'm happy to give up the first stages of a new bull market, whenever that may be, and just for me, there's nothing to do here. There's stock should have been exited long ago, and I don't see the buying opportunities in the index. Maybe there's something in specific stocks, but from an index perspective, it's a no-go. Better opportunities, I think, elsewhere in the Aussie market and the US market.
Yeah. Well, obviously, if you're a fundamentalist watching this, you might be looking at individual stocks and saying, "Hey, I could probably get some real bargains now in the Hong Kong market." Obviously, but being trend followers, it's certainly not the right one, not the right chart to be looking at. That's for sure. So,
and that's the thing with a bargain. A bargain can always go on sale again. So who's to say where the bargain finally hits rock bottom? It's an argument for a bargain could have been made last year, the year before that, and it's like it can be an expensive game trying to buy bargains. This is where it comes down to just not trying to be too clever. It's let the market show its hand. Don't try and tell the market what it should be, how it should be pricing something, because it's a recipe to lose your capital.
Yeah. All right. Fantastic. Okay, so that's a good rundown on the three main markets that we offer at Selfwealth. Let's go on to our topic of today, and I think we want to talk about some lessons that we learned from the stocks that or you invested in. So let's start from our winners, because we want to hear about them first, and then we'll get on to our losers. I'm going to say hi to Hassan, Mike, Michael. Thanks for coming, and thanks for putting your comments there, and Scott as well. It's much appreciated. If you do have any things we've got time to analyze at the end, we will as well. All right, but let's start with our winners, and what did we learn from them, Jace?
Yeah, look, I think it's always good to go through and have a look at your winners and your losers after each trade and just think about them. Okay, well, why did I get in? Why did I get out? Did I follow my trading plan? Did I follow my trading rules? Did I do something different? Should I have handled this in a different way? And just see, is there any takeaways? And there often is, even if it's just reinforcing why we do stuff. Going, well, look, I followed this through, and look, this is why I did that, because I can now see the outcome, and that's the outcome I should have got, whether it be a win or a loss. Sometimes a loss is a good outcome, and that can seem like a funny thing to say, but if you take a relatively small loss and the stock goes on and falls another 30, 40, 50%, your relatively small loss was a good outcome. And it's a good outcome because you followed your rules, and your rules helped save your capital when the position didn't follow through to the upside. And that's going to happen. There's nothing wrong with that. That's all part of the process. So what I thought I'd do is, I thought that to I always want to rather than just talk about hypothetical things, I like to talk about real things, like what's things that have really happened to either myself or our viewers who are leaving comments on the screen, or the members of my Motion Trader service. And I think a good way to do that is to actually I'm going to go into my Selfwealth portfolio, my real life Selfwealth portfolio, real money, and we're going to get my best 2 trades for last year and have a look at that. And it's like, I think it's important when you listen to somebody, you want to know that they actually do what they say themselves, because I know there's a lot of people who talk the big talk, but they don't actually have the game that follows. So look, I want people to know that I do what I say, and this is it. This is real. This is how it all works. So this is my portfolio. There's about 850k in open positions at the moment. So as I was saying in the ASX 200 section, I think the play here is to be long the market. So I actually am long the market, but I've got another 460 in cash sitting on the sidelines. So we're below that key resistance point. There is a little bit of caution coming into a key level. So I do have the reserves on the sidelines in case the market does pull back into the range. It's not an all-in game. So as I say, it's always managing risk. And one of the interesting things you can do in the Selfwealth portfolio, which, look, a lot of viewers will know this because they're Selfwealth users, but you can go into the My Portfolio section and go into the performance bit, and you can get your portfolio. So that's my portfolio there. And this line here is the ASX 200. So it's just a good measure to see your portfolio against the broader market, to see look, are you at market, below market, above market? And over the last year, so this is just measuring over 12 months. Over last year, I'm currently nicely ahead. It's not always that way. There are periods where I'm below market, particularly after corrections. I'll often go below the market when the market bottoms and rebounds. I've often sold a lot of my stocks on the way down. The market rebounds and I'm in cash. So the market often outperforms then. And also during sideways periods, I won't always be outperforming because I'll get chopped around in the sideways swirl of a consolidation. My strategy, my trend following strategies generally do best during strong upward phases of the market, and that's where I've had some good performance over the last few months, where we've had this upward phase in the market where I get on stocks that are running. That's where outperformance can happen. So let's actually go in and have a look at some of these holdings. So what I'm going to do, I'm going to rank these by profit and loss. So the best ones down to the laggards. So up the top, Duratec. That's my best performing stocks, currently up about 250%. And go down the list. There's so six stocks up 100%. So this is pretty typical of how a trend following portfolio would look. You're going to have, I think there's about 50 stocks in the portfolio. So let's say there's about 10% which are up 100%. So that's how a trend following works, in that a minority of stocks are going to be the bulge bracket of your performance. And then we come down the list and we get into the high double digits, come down. Then we've got the middle tier double digits, the double digits which aren't doing too much. Some of these are relatively new positions, so they're just getting going. Others have just not been very exciting, and that's going to happen. That's going to be probably the bulk of your trades, ones which aren't very exciting, and come down. And then down the bottom, I've got the losses, these ones in the red. And now you might look at this and think, oh, look, just about everything he buys goes up. But that's completely not true. It's because I'm always kicking out the ones which aren't performing, taking lots of relatively small losses and keeping the ones. So I'm a collector of profitable stocks. You could say I'm keeping the ones that are going up, I collect them, and I swap out the ones which aren't performing. So these ones are still in here. They haven't hit their exit points yet. Maybe they'll come good, maybe they won't. Time will tell. But there's been plenty of these ones which have hit the exits over the last year. It's not a case that everything does what these top performers have done. That's not how it works at all. So let's what I want to do, I want to go through the top two. Let's take the top two and sort of see why are they there? What's worked? What can we learn from these? And because a good trading process should be repeatable, and this is key. Unless you can actually write down what your process is, it's probably not repeatable. And if you couldn't explain your process to somebody in probably 60 seconds to 2 minutes, if you can't explain your process clearly within a couple of minutes, it's probably not a process. And if it's not a process, it's not repeatable, because it's relying on the vagaries of the market to do well. You want it to be repeatable. And so let's go through and see what's been repeatable about Duratec and MMA. So let's start with Duratec. DUR is the ticker code. And so this is a interesting stock, Rog. It's involved in concrete remediation. I'd never heard of it when it turned up in the signals. It's I can't remember what the market cap is. It's a few $100 million, so it's not like a tiny speculative stock. No, it's that has 10 million in capital. It's like it's a substantial company, but it's not. The ASX has a lot of companies in it, so it's not an ASX 300 stock. So I'd never heard of it, but nonetheless, it came up in the signals. So just having a look at how this all worked out, listed in 2020, didn't do much over the first few years. Was falling, as below these moving averages. Not interested. I don't want to know when it's below the averages. Then the averages started to turn in July 2022. Price moves from below the averages to above the averages, so that's when it starts becoming interesting, and that's when for me the buy signal happens. So the buy signal for me, stock is above the 50 and the 100-day moving averages, so where this green circle is, and then it trades at a 70-day high. 70-day high is not a magic number, but it's an extra confirmation that the price is moving upwards. So that for me that was an entry signal. And I've got this second I missed it on the I didn't buy on the initial signal. I missed it. For some reason. So this is my entry here. So and this is one of the things. There's always another opportunity to get back into a stock. It's not a case of like if you miss your first signal, you can't get into it. So I missed the first signal. The stock started to pull back. So it was, and this was during 2022. So the signal was in August 2022. The market bottomed in October 2022. So you just think about the negativity in the market at the time, and this is why I missed it. I think because I was focused on there was just so much gloom in the market, and the S&P, the All Ords, was heading down. So I got the signal. I was hesitant to take it initially, pulled back to the moving averages, then started to rebound off the averages, and I got on board, and got an initial rally, and then we've got this pullback. And I think this is the first lesson. So let's have a look at this pullback. So markets, it's come back 17%. So this is after a 1 year decline in the market. I'm up 34%. So 34% gain would often seem pretty good. And we've been through a period where the S&P 500, like let's just have a look. We've been through a period where the S&P 500 has just had an awful period, and quick 34% gain. The temptation always is to like lock in a gain. And I think this is lesson one. Be willing to risk a modest early gain in order to stay on a potentially much larger gain. And that's one of the things I did. I held on during this period, and this is the key. This is one of the keys to setting up being in this stock now. I risk giving back this modest early gain of 30%. It's a nice gain, but 30% is still a modest gain, or a modest to moderate. Willing to give that back. Came back to the 50-day moving average, started to rally again. And lesson two, I think, is to then let profits run. Let profits run, see where they go. Don't have preconceived ideas on where a stock should be. And I see people fall into trouble with trying to assess what fair value is and having a profit taking at where they think fair value is, because really no one really knows what the proper value or what the value is going to be. It's the market's going to determine what it determines. So I think fair value can really throw you off a bit. So for me, it's about letting profits run, not trying to cap my upside. And as we can see, this has run quite nicely over the year. From the entry point, risking a modest early gain, letting the trend run. Then the other thing, Rog, is using a wide trailing stop. So you can see off these pullbacks, which you can see along the way. So let's just measure this pullback out. That's a 20% pullback. So how do you see off a 20% pullback and stay on these trends? This is where so many people find it so hard to get these 100% plus moves, because the market's constantly shaking people out with these pullbacks. And the answer, I think, the lesson that runs with letting profits run, I think it's actually stapled to letting profits run. It's let them run with a wide trailing stop, a stop which will track comfortably below the share price to give it room to move. So my trailing stop on Duratec now would be around, I don't have it in front of me, it's probably around about $1.18 thereabouts. So it's still comfortably below where the share price currently is. Should we go through another one? How about?
Yeah, I was just having a look, because I was on this stock at 85 cents based on similar tactics. I got out at $1.10 just after that previous peak, not the last peak, the previous peak.
Around this one here, Rog?
Yeah. What would have kept me in the stock? What would have kept me in the stock? Because I had a 25% stop loss. So I think, yeah. So that was the point that it peaked. Then I had a 25% stop loss. So I got out in October at $1.10. Right.
Yeah.
Obviously not kicking myself, but it's following the rules, right? So following the rules.
Like a percentage-based trailing stop is good. It's easy to calculate, and it does work. It can keep you in a stock for a long time. The problem with the percentage-based trailing stop is that it's generic. It's not tailored to the specific situation. Some stocks can be more volatile than others. So 25% on a property trust is going to be very different to 25% on a small cap like Duratec. What I prefer to use is an ATR based trailing stop. And so this isn't what I'm showing you now. It's not the motion trader stop, because motion traders is a little bit different. It's a trading view trailing stop, it's a good approximation of what my motion trader stop does. And now I'm just going to adjust it. And I use, I just got to find the right thing to adjust. I use a multiple of 10. So I measure my algorithms do. They calculate the average trading range of a stock over the last few weeks, and then they multiply it by 10. So that's a pretty wide stop, and some people find that pretty uncomfortable. But there's a reason for doing that, in that it gives the stock more room to move. So this is the where you got shaken out the 25%. So there's 25% about there, and let me just mark it in differently. So there's 25% thereabouts. So a 10 ATR stop gives it a lot more room to move. Now, some people say to me, hey, why are you risking so much? Why are you risking giving back so much? And the reason I do that is because it helps me stay on these big trends. And this is where my portfolio is making most of its money. It's from these big trends which may last for 1 to 2 years. After 2 years, there's typically a correction which will trigger the trailing stop. I haven't had too many stocks go past 2 years. But within 1 to 2 years, you can get these big trends, but you've got to give them room to move. It's such an important concept. It's if you're going to get one concept, it's give your winners room to move. People like to protect open equity with tight stops. Some people use, say, a 50-day moving average, and that's pretty good. That can keep you in a stock for quite a while, but it doesn't adjust to the stock's volatility so well, and it will trigger an exit. A 100-day moving average, yeah, it's similar. It can be a pretty good sort of proxy for a trailing stop. 25% is pretty good. I think ATR it's better. I think there's no optimal way. There's no way to get out at the high, none that I've discovered at any rate. But the best way, I think, to get those big triple-digit gains, it's that wide trailing stop. And it goes back to lesson 1 from this trade: be willing to risk a modest or moderate early gain, or in the case of Duratec, be willing to risk a reasonable portion of a big gain to get an even bigger gain. And they're possible, but you've got to. There's no way around it. You can't get through these pullbacks unless you got a decently wide trailing stop. Doesn't have to be like, no trailing stop and you risk it all coming back to zero. It does get you out, but you're going to make your gains from those few that go a really long way. And this is how you do it.
Yeah, very good. I think I might have to rethink the 25%. I like the ATR. I'm starting to like the ATR, so I might have to rewrite my trading plan again. Thanks, Jason. I think instead of going for the winners, let's have a look at the losers, because we learn more from the losing ones than the winning ones, right? So let's have a look at one of the losers.
Yeah. Okay, that's a good idea. And because it's not all Duratex, and those other stocks you saw, those other 5 stocks that are up over 100%, it's not all those. That's the minority of a profitable portfolio, most likely, particularly a trend following one. They're going to be a minority of stocks. They're a very important part, but they're typically a minority. You're going to get a lot more losing trades. So I'll show you my worst trade last year. It was a company called MTC. Where is it? Metal Search. And so let's start with how it all looked. So this is a stock which had been, we had a big high point in October 21, big decline, And then it went through a period where it seemed to be building a sequence of higher highs and higher lows. And the moving averages turned up. There seemed to be makings of like, is this stock setting up a launching pad for another big run higher? And so it had a nice rally off the moving averages, triggered a signal, so above the 50-100-day averages, 70-day high, broke out above. You can put on some classic sort of like overhead resistance, and you could also call this, you could really also call that generally a big consolidation band. So we've had had a boom, we've had a bust, we've had an initial rally, we've had a sideways period which looked like it could have been forming a big platform for another strong rally. Maybe it was about to head back up to these previous highs. So where that green circle is, that's where I got the entry signal. That's where I bought. But that momentum didn't sustain. It wasn't long. It was only a couple of weeks. Came back to the moving averages, rebounded. Still looked like this was in play. So at this point, it was just coming back to the breakout point, back to the old resistance, which is now support. Rallied off that, still looking encouraging, but then from there, it started to fall apart below the moving averages. Moving averages cross. The green circle is where my stop loss was. So it triggered the stop loss, and I was out. Now, I think the big lesson in this, it's better to take a relatively small loss early than taking a much larger loss later. And I think this is a mistake a lot of people make, is that they become hesitant. They don't want to lock in a loss. Like I hear people say, look, it's not a loss until you take it. And I think that's completely wrong. It's your stock's worth what someone's prepared to pay for it today. And if it reaches your exit point, that's a loss. It's a loss. Whether it's been realized or not, it's a loss. And so this got to the point, it's I think it was 30%. It's just measure it out. So that's 35, say it's 35%. So it was based on the stock's volatility, and it was an ATR-based stop loss. So 35 was the correct measure for this type of stock. The upside from this stock was, it's one of those ones which could have gone 100 or more percent to the upside. So it was asymmetric. It was it was following the rules. The entry point was right. I said earlier, a loss can be a good outcome. And this was a good outcome because I followed the rules. I got in at the breakout. I got out at the exit point. It would have been nice to make a profit, of course, but the outcome was fine because some are going to be this. And what made it a good outcome was because if I'd held and hoped for a recovery, well, you can see it continues to fall away. And this is where I think a lot of people go wrong, Rog. They find it hard to accept being wrong early, and they let a small loss get out of control. So this is what you saw in my portfolio. I didn't have a whole lot of dead wood sitting at minus 50%, minus 60%. I'm turfing them out. I'm constantly culling them. I'm getting rid of them. 35%, that's one of my larger losses because often they're out before that. I also use a time stop. So if something hasn't performed within 60 trading days and it's showing a loss, might only be down 5%, I'll kick it out. So I've got lots of these relatively small losses. Well, actually, a lot of them are actually just small, 5%, 6%, whatever. 35% is still, it's still relatively small compared to the upside which I can get, which is triple digits. But that's a big lesson. Big lesson. Don't hope they're going to come back, because what you've got to ask yourself is, if it comes back, well, that's great, but what if it doesn't? What if it keeps spiraling? Then you got a portfolio full of a whole lot of rubbish, which is just going to mentally wear you down. It's going to take away your capital. It's going to make things really tough. Another example is a stock called QHL, Quick Steps Holdings. And it's a very, very similar sort of situation in that had a decline, looked like there's a basing structure in place. Moving averages cross, prices were starting to trend nicely. It looked like it could have been the early stages of a big decline. I probably got in on the day the stock made a high, and that's going to happen too. It's a bit frustrating when you look at it going, oh, geez, if only I'd waited a day, but it happens. So many times I've bought at the high and sold at the low. It just happens. And some people say, oh, just my luck. It's not bad luck. It's just the way the markets are. You buy with the momentum. Sometimes the momentum doesn't follow through. Stock came back to the averages, initially started to hold, but then quickly gave way, cut the position, and it hasn't fallen away as much as the other one, but it certainly hasn't done anything. And in the meantime, that capital has either gone into other stocks or it's earning interest in the bank in that cash component I've got, instead of sitting here being a dead weight, me hoping that it's going to bounce and not turn lower again. So I think the lesson here is, a bad situation can get worse. And the mistake I see so many people do is they either, maybe they double up. They say, look, I'll double up and it's only got to get halfway back and I can sell and I'll get out at evens. So it's, get out at evenitis sort of thing. You've got to get out at even. So many people think you don't need to get out at even. You just got to protect your capital. That's what you've got to do. And I think, trying to get out at even is, or doubling up, and it really compounds a situation which isn't working, and it can make that situation a whole lot worse. Yeah, sure, sometimes you will get out at even, but more often than not, if you're fighting the market's trend, it ends really badly. I'll just quickly show you the worst stock last year. So I looked up the ASX 300, and just over the last 12 months, this is the worst stock. It's a company called. Actually, I'll use the second worst stock because everyone knows this one. It's Star Group. You can look up the worst stock yourself, APM, and the same things I'm going to say about Star Group will apply to it. So it's SGR, and that is the casino operator, Star Entertainment Group. And this is down about 70%, same as the other stock, which I could have spoken about. And now, there is absolutely no reason anyone should currently, if you study charts and you study trends, there's no reason anyone should currently have this stock in their portfolio. And it's really simple stuff. Look at the 50 and the 100-day moving averages. Since November 2021, so that's for over 2 years, this stock has spent almost all of its time below declining moving averages. There has been not one buy signal based on my buying criteria in over 2 years. So this is a completely and totally avoidable disaster. And even if you bought it on this high point, so using my criteria, the moving averages had crossed, the stock made a 70-day high. Even if you came in and bought it on the actual high and you put a stop loss, say you use 25%, there's your exit point. The exit point, the Star, if you bought it at the high, should have been about a 1 week lower, 25% loss, move on to other things. But how many people do you think have been holding and hoping and are down another 85% from that point where there could have been a calculated exit, and people doubling up, people punting. Oh, look, is this so low? It just goes on. I can talk about this for a long time, but these are the capital destroyers. And if you have too many in your portfolio, you're just going to be an underperformer. Your portfolio is always going to underperform. So this is where our performance comes from. We're cherry picking. We're taking the parts which are breaking higher. We're seeing whether they rally, like Duratec. We're giving them a chance to run. We're risking a modest to moderate early gain, but then we let them go. And so we're cherry picking. We're taking those good parts, we're keeping them, and we're jettisoning or completely avoiding the parts like Star Group, which are pulling the index lower. So if you do that, that's where you can really get outperformance. It's not rocket science sort of stuff. It's not having a crystal ball. It's not about knowing what the market's going to do next. It's just playing momentum. It's playing the numbers. It's managing risk. It's as I say, I can tell you my process in under 60 seconds. I'm continually doing anyway. So it's but yeah, that's yeah, just interesting. I think, Rog, looking at these best performers and worst performers from last year, and you can see how it all comes about. And I find it fascinating just to go through and review it and see how avoidable and how gettable the winners and the losers actually are.
Yeah. Yeah, and of course you've got to understand. I see the note here from Rob behind the desk there. Look, even if you hold Star Group because you've got something personal about loving that company, that's a fundamental approach, and that's fine, right? It doesn't mean you have to go out and sell it based on what we've spoke to today, right? This is
And I did say from a technical and a trend following perspective. So
general
not everyone
information
does that. So some people are strictly fundamentals, and they go through and they're looking for value, and that's a completely viable strategy. And there's some great value managers out there and value investors who'll own a company like Star, and they'll have a reason for it. But if you're studying charts and you're a trend following trader / investor, there's no reason you'd be holding a stock like Star. And if it does bottom and it does rally, you're not going to get the low point. Whereas a value guy, maybe they do. Maybe they are there at the low. So they're different approaches, but it's about working out what works for you. And if you are the value guy who wants to go into Star, that's all fine. But I think even the value guys need to have a point where they say, okay, this isn't working. Where do I get out? Because I've seen value guys blow up major funds by not having to get out points. Because the ego gets involved, and it's like, I've analysed this better than the market. The market's wrong. This is going to go up. Market doesn't care what you think and how you've analysed it. I think no matter who you are or how you approach the market, I think having that point where you say, look, I thought I was going to be right, but the market's not agreeing. I've got to walk. I've got to protect capital. I think that's just good sense, no matter how you approach markets.
Yeah, and I think this is where we sort of, I'd love to get on some of the codes that we've got, but we'll probably get onto them next week for sure. But I think the key word here once again is protecting your capital. I think that's always been the number one thing that was taught to me, and I've had some lessons, there's no doubt about, where I didn't protect my capital, and I should have. But when you're looking, when I know I've seen people's portfolios, and they just get so disheartened when they see that they have no more capital to trade because they've let all they've got no plan, they've got no stop loss, they got no, even if they're fundamentals, they got no plan, right? So they'd love to continue investing, but they got no capital left, right? So it's whether you're a small player or a bigger player, right? Protecting your capital, I think, if we're talking about 5 big lessons from 2023, should have been that should be the number one, is how to protect your capital, right? Having a plan to protect your capital. Especially now the interest rates are higher as well. So, if you're not in the market, you could at least be getting returns on interest, right? Returns on cash.
Yeah. So, look, I think the first question we should always ask when we're looking at a stock is like, how much could I lose? It's not. I think a lot of people get it the other way around. I think, what could I make from this? It's like, well, first, let's think about, like, where's that? We've got to work out what we could make to work out whether it's an asymmetric opportunity. But the first thing is, like, look, what can I lose here? Where's my downside? And then if you decide, okay, look, my downside is acceptable, it's like, okay, now what's the upside? And this is where you start to work out that equation, that risk reward. Is it asymmetric? Am I taking on too much risk for too little reward? So, okay, that doesn't stack up. I play that sort of scenario day in, day out. It's not going to work for me. It's looking at those situations where, okay, I can lose I can lose 10%, but I can make 30%. Okay, that works. And you never precisely know how much you're going to make. It's just it could. Yeah, I can see a pathway where this could go a certain distance, and that would justify the risk which I need to take. And when that equation stacks up, then you got a possibility to place a trade with.
Yeah. All right. Well, look, Jace, it's been almost an hour. Do you have another 5-10 minutes to have a look at a couple of stocks that have been listed here on the chat? Or
Yeah. Let's have a look.
Yeah. Let's just have a quick look at ACF to start off with. Let's do like a 1 minute analysis of each, right? So we don't hold all our viewers' time as well.
Okay. Do the rapid analysis. ACF.
ACF, yeah.
I think that's arrow. Yeah, this is.
It's looking good.
Yeah, I think it's. Yeah, it is. It is. Look, it's. I'm pretty sure it's a motion trader stock. And it's trends up. Its moving averages are rising. It's above the moving averages, and this is. This is a situation where if I was holding this stock, I keep holding it. There's no reason for me to sell this. This is where I'm using the trailing stop loss or the trailing stop. I don't want to cap my upside because you never know how far these stocks can run. Like we could have looked at this. We could have looked at this in say where's this February last year and gone, oh look, it's had a big run. Surely this stock's getting close to taking a break. Maybe it's time to take profits. But this is the thing. Look what's happened since then. It's had a pullback, and people go, oh look, I knew it was peaking. This is it. It's done. It's time to get out. It's going to keep falling. But then it stabilizes, it goes up again, and it just keeps going. So I don't know how much further this is going to rally. It could double again. It could top today and start to come back down. But for me, it's about this trend is well and truly up. I'm happy to sit with a stock like this, use the trailing stop, except I'm not going to get the high. There's nothing wrong with taking some profits along the way if the open equity is becoming too large and taking on too great a weighting in a portfolio. These are all individual choices that people need to make around their own situation. But as a general proposition, I'd be letting my profits run.
Okay, fantastic. Now, I know we've done this one a few times last year. Has RMD turned around, or is it still pretty much on the way down?
Look, signs of a potential turnaround. It's above the moving averages. They haven't crossed yet, but they're getting pretty close. Look, there's definitely potential. For me, it hasn't met the buy criteria yet because the moving averages have to cross. So look, there are all sorts of possible ways this could play out. If somebody was really keen on it, look, there is a case to be made. It could be like someone could enter now and they could put a stop loss just below this previous high in January. So that would be you could. It's possibly like a 12% stop loss, 10-12% stop loss. Upside if it keeps going up, but maybe it's 30%. Maybe you can say, look, I can make a case for 3-to-1 risk reward. Maybe it continues rallying even further. So if somebody really likes the fundamentals, maybe they've got a reason why they want to get into this one once they think a bottom is in. This is where you can combine the fundamentals with the price analysis to go, okay, I've liked this stock during the fall, and now I've seen it stabilize. It's moved above the moving averages. That's a sign for me. I can now back my fundamental view, go with the momentum. That's completely reasonable and a reasonable thing to do. For me, it's a bit early. I'd like to watch it, but it's got the encouraging signs, and you can see where a case could be built for it.
Okay. What about GNC?
Was that GMC?
GN in finale, and then C for Charlie.
GrainCorp. It's an interesting one. Yeah, it's interesting. Like we've got this big rally into 2022, and then we've got the decline, and now we've got the sideways. So it's like, so this is sort of like the range which I'm looking at. It's like, how does this range resolve? Does it break to the downside or the upside? So my bias would be the upside because I think that's the bias for the market generally. And it does, the pullback does feel proportional to the rally. So the big rally, and then the time it's taken, the amount is pulled back. it all sort of looks like it's part of a consolidation which could support a higher price. It looks like this could become a platform, and we could get the stock, moving higher over the months ahead. But we don't know. We don't know if it does break to the top side. We don't know when that's going to be. This rally off the low looks quite impulsive, whereas the pullback has taken longer, so it feels more corrective. But look, the moving averages aren't decisive. I'd probably be watching the most recent high. It'll be interesting if it starts breaking above the recent high. So we've got a bit of a range within the range. We've got the low, the recent low. You could even use the recent low from a few weeks ago. Which way does it go? It's look, positive bias, but it could stay range bound for months. Wait for the price action to give you the trigger.
Yeah, exactly. All right, fantastic. We'll just do a couple more. The question is, when and why did you sell BMN?
Bannerman. Well, I haven't sold BMN. This is one of the stocks in my portfolio. It's a motion trader stock as well, and still in my portfolio. Not the one I showed you previously. I've got other portfolios. The one I showed you previously is one built around the motion trader service, and then I got other portfolios which are discretionary. That said, I bought around the same time I got a motion trader signal in around, I think it was around August last year. Bannerman's still in the motion trader portfolio, and I still own it. Trend's still up. Uranium's had such a big run. It's like just looking at a uranium chart. It's like, this is extraordinary. It's up something like 70% in, that's from July last year. So what, in 7 or so months, up 70%. At some point, you'd expect there'd be a big shakeout, but who knows where that'll be? It's the same story. Let the trend run, see where it goes, because it can often surprise people. Going back to Bannerman, for me, it's a case of it's just come out of this consolidation band where it had the nice run, pull back towards the moving averages, a compression zone where the price action really compressed, and then it broke out again. For me, it's probably not an asymmetric entry level, but it's one which, I am still holding it. I'm just seeing where that momentum takes it.
Yeah, so looks good. We'll just do one more. ACF.
ACF. Oh, we just looked at ACF.
Oh, did we? Sorry, the AD8. We'll do two more. AD8.
AD8, Eduate Group, I think that is.
AD8, yep.
Edunate.
It's a
like this is another. It's another. What was that, Rog?
I said these are all booming stocks. The crowd are picking the right stocks.
Yeah, well, there's also another motion trader stock. It's and chances are, if it is a stock which is within an uptrend, it is a motion trader stock, simply because that's what the service is all about. It's identifying momentum and then letting those ones which keep running, let them keep running, see where they go, and if they're not running, turf them out. That's the process. Trend's still up. It's up at all-time highs. It's like, look, it's a hard one to buy after such a big run. But look, I've seen these before where these big runs turn into even bigger runs. But it's still a hard one to buy. If I had it, I'd keep holding it. I'd be using the trailing stop loss and giving it room to move. See what happens. It's always like, I know how tempting it must be to just say, look, I'm getting out. I'm taking a profit. But you think, well, the reason I'm in this place. The reason I've got to this point is because I've let the profit run. So it's like I wouldn't want to short circuit what had gotten me there in the first place, just letting a profit run. So I resist the urge to lock in a profit. It means I always miss the high. I'm out sometime after the high, but that's the price for staying on. Someone could have said at $14, look, surely I'm big spike upwards. That's it. I'm out. And then they look a few months later, it's up again. So the trailing stop will help you capture these moves, but of course you're going to surrender a bit at the end. It's just It's everything comes with a cost, and the cost of the trailing stop is what you give back at the end.
Yeah. All right, Jason. I think we'll leave it at that. Look, once again, everyone, thanks for coming and watching us, and hopefully we got some good lessons from last year that we can apply in 2024 and have an even more successful year. So far, the markets are looking good. The AU and US ones, which is great. Let's hope they keep on going that way. We've just got to stress that this is just general advice. Obviously, do your own research, do your own diligence on your stocks that you're going to pick or sell. But we love coming every week, as we will try this year, just to continue this education. We want member tips coming in even beforehand. That would be great, right? So it gives us a bit of a heads up, or any questions you may have, just send them to the general support at selfwealth.com.au. They'll somehow get to me, no problems. Or even Jason, thank you very much for today. Much appreciated once again.
Yeah, it's been fun, Rog. It's been good being back, and geez, we covered a bit of ground, and but hopefully it's progressing. Just going through, thinking about those lessons from what's worked and what hasn't, and even what hasn't. It's not a bad thing. It's not bad when a stock loses money. It's bad if you do the wrong thing after you've got that loss. You know, you're doubling up and letting losses run and all that. That's where it all doesn't work. But losses themselves are part of the process, so we've got to expect them. We just got to manage them. That's the key, managing them. And
the idea is to avoid becoming a gambler, right?
Part of it.
The idea is to avoid becoming a gambler, right? So, all good. All right, no worries. Thanks, Jason, and we will see you here same time, and hopefully everyone else. Please don't forget to like, subscribe, and write any comments you have. And we'll see you next week.
Good one. Thanks, Rog. Thanks for yours.
Take care. Bye.